folks. Bill and Brian here with Energy Rogue. This week, we're giving you an update. And guess what? We're going to talk about the most mispriced molecule on planet Earth.
On planet Earth? Well,
Okay,
I did hear we were
it
going
may
to
include the
Mars.
moon.
It may include the moon.
It may include the moon.
It may include the moon. So we've received a lot of questions on this.
I don't know. I haven't checked with the, but that could trust me true.
Yeah, we've received a lot of questions on this. So we wanted to get this out there because a lot of people have been asking, well, if TTF and JKM they've gone up since the Iran-US war by 50, 60, 70%, somewhere in that range, whereas Henry Hub actually went down. So we have a mispriced molecule if everything is held equal. So we wanted to demystify why would Henry Hub be so low and these others be so high, and create a $12 per MMBtu or decatherm spread. So that's what we're going to talk about today. We're going to talk about the $12 paradox. And this, by some people, is a spread that should not exist, except for it should. So, but this has to do with fixed capacity, slow timelines on infrastructure, as well as more supply. So one of the things to look at is how much export capacity the United States has out of the United States. So how much export capacity? Right now on this chart, we're in 2026, we're sitting about here. The nameplate is around 17, I think 17.9 BCF a day, but they can overrun that. So they can overrun the nameplate capacity. There's some tuning and some things that they can do, but approximately 20 BCF a day.
They can overrun the nameplate for a certain period of time. They can't do it all the time.
Right.
Certain conditions have to exist.
And I would say that most, the last 45 days have been overrunning as much as possible because that $12 spread does exist for somebody, not everybody, for somebody. So when what's that?
For the spot market.
Oh, yeah. Well, and that's the other wrinkle. Much of these molecules have been in long-term contracts. They are hinged to pricing mechanisms on Henry Hub, but these are long-term contracts. So many of these are not spot contracts. But the main point is we are filling all of our export capacity right now, today. So European storage, so one fact is we're maxed out on our LNG export capacity. Another factor to consider is European storage. It is a ticking clock. The current level is about 28%. Required by November 1st is 90%. That is a huge gap to fill, much bigger than last year, much bigger than the last 3 to 5 year average. So this is non-negotiable. This needs to go in. And the key question is, when they receive LNG and it's hot, they may need some of that LNG for power generation for air conditioning load. But they need to fill the storage capacity, right, Bill?
That's right. And the other thing you have to remember, European storage and American storage are different in that the European storage, every country owns a piece of it. And every country's fills factor may be different based on the weather they had in that country.
Mm-hmm.
And so while France may be lower than 28%, Germany could be higher than 28%, depending on how that went. And there you go. You've got it pulled up right there. This is where we track, and you can track as well, all the different storage ownership. And you can see that it's not just like 2 or 3.
And look at the Netherlands. 7% full. And that is actually one of the biggest. And that's part of the reason that this is coming into focus, because normally the Netherlands is leading the pack on storage. So this is a big factor. So the U.S. doesn't have excess LNG export capacity. Europe needs to fill their LNG. Let's keep rolling. Let's see where we go.
There's the
Qatar.
big one right there. Yeah.
Okay. So out of the United States, United States provides roughly 25% of the global LNG. Qatar another 25%, Australia another 25%. That's average numbers, but Qatar lost 17% of their capacity for at least the next 5 years because of the attacks that were happening.
Right.
Iran struck Qatar for being having a U.S. base, or I'm not going to get into the political conflict there, but there were attacks on the LNG facility, and that permanently changed how much capacity that they have, and they lost 17% of that. So 17% of 25%. I mean, you're talking, what is that?
Talking about
Um,
7% of the total world.
7% of the total world LNG just is gone.
Yeah.
It's just gone for the next 5 years. And guess what? This is the fastest growing segment. Crude oil demand has been growing slow. LNG demand has been growing significantly. So, what are 3 reasons that the spread won't close? Pipeline takeaway constraints. It can't get there from here, which is it can't get from the field onto a ship because there's pipeline constraints, but there's also ship constraints on the LNG export capacity. We also have associated gas flood. We have so much gas in the Permian right now that it's a dislocation. We have so much gas in the Permian, there are other parts of the world that actually need that gas, but we can't get it there in an economic fashion. And then the last one is a hard LNG export ceiling.
Right.
And the export capacity is limited to 17.9, but we've been averaging about 19 for the last 45 days. That's kind of what we've been averaging. But new capacity is going to take 3 to 5 years to permit to get on. So let's talk about the constraint number one. Waha price goes negative, the Permian trap. So when we're looking at May prices, May is minus $2.50. So when we're talking about Henry Hub at 271, Waha is trading minus 220. So that's almost a $5 delta to where Henry Hub is. So that is one thing to consider, is the basis at Waha is $5-6 because it's just, you can't get it out. There's not enough
Right.
pipeline capacity.
And the only way that trades like that is that it's got to be associated with oil. They have to make up that revenue on oil revenue,
Mm-hmm.
which means that affects their oil basis as well.
Right. Right. Well, because a producer looks at all the economics on the revenue side and the cost side. And with gas being on the cost side now it's becoming a drag to some of the oil revenue that they're getting. So constraint number two is associated gas. This is the involuntary supply machine. So with oil economics at 75 plus, it triggers production. We haven't seen rigs added yet, but that's a
Yeah.
story for another day. Um, Oil is then produced, and associated gas becomes a byproduct. And you can't produce the oil without flowing the gas. This is part of the reason that you will hear about gas flaring or Bitcoin operations. They're trying to do something with it because they can't produce the oil if they can't get rid of the gas in one way, shape, or form. But that creates a Waha. Oh, go ahead.
And they may go ahead and produce the gas because this gas is actually liquid rich. And so the liquids end up paying for the gas as they
Right.
sell the liquids. But in order to do that, it has to be processed in the field.
Mm-hmm.
And then you start
Um,
running across capacity problems there as well.
Well, that's what creates the Waha Hub bottleneck. That's stranded or sub-zero pricing. And then you have constrained capacity. Henry Hub price remains suppressed because it's got adequate supply. So constraint number 3 is just a hard ceiling on our export capacity. 17.9 is the nameplate. With Golden Pass it is starting up. It got about a quarter BCF a day. I think the last that I looked, and it might be inching up a little bit more. So now let's take a look. We just looked at the US. There's excess gas, but we can't get it out because we have no more export capacity. So that means It's just stranded in the United States, which is a great pricing dynamic for consumers in the United States. It's not a great pricing dynamic for producers in the United States. So now let's take a step back. Let's look at the global demand. Europe, which is predominantly driven by TTF, which is Tidal Transfer Facility in the Netherlands, European refill has to happen. And at 28%, they have a long way to go. So they are going to be bidding up every cargo. And with limited capacity coming out, Qatar, we just said 7.5%. That's the permanent offline. None of it is flowing right now. Absolutely none of it. The facility is shut in. So over 25% of the global LNG is just offline right now because of the US-Iran war. So bear that in mind. Then you have the Asian JKM premium. This was the destination for most of the Qatar LNG, was going into Asian markets. And JKM stands for Japan Korea Marker. So this is traditionally why it's priced a little bit higher than TTF, just because there's so much demand in Asia. And then a China reemergence. China's LNG imports have jumped as industry recovers after COVID. Now, something interesting was China was getting about 10% of their imports from the United States. Now it is 0. So that means China is really exposed in the LNG marketplace because a lot of that was coming from Australia and Qatar. So those are 3 major things. So Bill, why is this a structural dislocation, not a trading glitch?
It's dealing with physical volumes. Anytime you deal with physical volumes, you're talking about something that goes down to the core. Traders usually like the volatility that comes from not very long-term disruptions in supply or disruptions in market. But what we're talking about is something that's going to have a very base change in how the world does business with natural gas and crude oil. And we could do a whole show just on that statement alone.
Right.
But so that makes this more structural and not just, oh, the traders are trying to run it up or run it down. Actually, this could cost a trader a lot of money if he's not careful.
Definitely. And this is part of the reason. That Bill and I actually created Energy Rogue and Rogue Radar. Let's see. It's probably time. Should we do our sponsored?
Yep. We got to pay the bills, Brian. We got to pay
the bills. Okay, so we're going to do a moment of a word from our sponsors. We got to do one thing of prep. It's going to take about 2 minutes. So hang with us. Hang tight for just a second. So we've got a special sponsor today, and Bill, are you gonna hit the sponsor?
I've got it coming in, and it is brought to you by.
It's 5 in the morning. I got 17 browser tabs open, and I still don't know if crude is going up or down. This is the chaos chamber. Woke up in the morning, got my EIA OPEC report drop. What did it say? Platts on the left, targets on the right. Bloomberg terminal burning all night. Spreadsheet warrior, data janitor, 30 hours weekly, amateur. temperature. Charts on charts on charts on charts. Markets moving fast and I'm falling apart. $50,000 gone. Still can't tell me what is going on. Boss walks in. I got nothing to say, sir. I've been researching since yesterday. Data janitor. That ain't me no more. Rogue radar. Walk right through the door. Green means go and red means stop. Yellow means watch. Don't let it dry. 5 minutes. That's all I need. 30 hours. Yeah, we set them free. Energy. Rogue. 5 years strong. May the 4th. Woo. We've been right all along. Used to spend my Sunday nights in pain. NGI and Platts gas daily going insane. Weather models, rig count, storage flows, demand scans, refinery runs, nobody knows. Then 2 guys in Oklahoma said 55 years. Let's use our head. Built a weapon called the Rogue Method. Visibility, velocity, validation said it ain't about more data, son. It's about the signal when the noise is done. Clarity equals signal over noise. Cut the chaos, hear the market's voice. Rogue radar runs the math at night. Wakes up before you gets it right. Green, yellow, red. That's it. 30 hours just got smoked. Admit it. Data janitor. That ain't me no more. Rogue radar. Walk right through the door. Green means go and red means stop. Yellow means watch. Don't let it drop. 5 minutes. That's all I need. 30 hours. Yeah, we set them free. Energy. Rogue. 5 years strong. May the 4th. Woo. We've been right all along. You've been spending 30 hours a week being a data janitor. We built something that does it in 5 minutes. It's called Rogue Radar. You're welcome, energyrogue.com.
We got to do our, back to back. So, so listen, what we built is Rogue Radar. After spending 30 hours a week trying to understand energy markets, we built a tool that gives you everything that you could possibly want, from fundamental analysis, market narrative, technical analysis. This even takes in, for natural gas, the BCF a day versus the baseline for weather forecasts, on crack spreads for crude oil. This covers everything from production to consumption, to storage, to stocks, to imports, exports, power burn, everything that you're going to want to know in the energy markets. And we've got that packed into a subscription that is $89 a month. And if you follow energy markets, there is a link down below for our free ebook called the Rogue Method that is going to give you everything that you're going to want to know when you're studying up on energy markets. So download that below. It's totally free. You got to put in your name and email. Yeah, we're going to send you some emails. So anyway, that's us. So now what could break the spread? Okay, you got Henry Hub at 270. You've got TTF and JKM sitting 15, 16. I saw them upwards close to 20 like a couple weeks ago, but they've kind of come off. What are 3 things that could break the spread? Now, one is we have a big summer heat. That is going to bring Henry Hub up, but that's not interrelated to TTF and JKM. That's just coincidental.
No, yeah.
It's just coincidental of incremental demand, right?
Right. That's all you'll see is more demand. If you see more demand in the U.S., the price is going to go up. It would not matter what the price of TTF or JKM was. It would go up anyway if this would happen. So it's not really breaking the spread. It could tighten it a little, but it's not a what do we call it? It's not a correlation. It's just it just happened at the same time.
Correlation doesn't cause
it's not
causation. There you go.
That's right.
So Golden Pass comes fully online. Part of it is online. That's going to help it somewhat. That is going to add export capacity, but that's going to be filled up day one because there's too much gas in the United States.
Let's start off with the fact it's already got contracts on it.
Yeah. So
they had contracts long before Qatar went under.
Yeah. And all of these would bring Henry Hub up and TTF and JKM down. theoretically. Well, not the summer heat. EU panic. That's not going to do anything. That's going to be neutral. That's not going to do anything, or it shouldn't do anything. For example,
You could,
I
you
came
could
up
see
with this.
some
I came up
you
with
could see
this
some
example.
price majeure maybe.
Yeah. Well, I came up with this example to somebody. I said, say you have 10 apples and you bought them for $1 here in Colorado. I'm in Colorado. So say you bought 10 apples and they were $1 a piece. But in New York, you could sell them for $20 a piece. Well, what should you do? You should take it all the way there. Only problem is you don't have a car and all the trucks don't have excess capacity to get it there. You could walk it there, but then the apples will spoil by the time you get there. So it doesn't really matter if New York apples are $20 a piece. It doesn't really matter because you can't get it there. So,
Right.
or as they say in the Northeast, you can't get there from here. I can't do the
Exactly.
Northeast accent, but okay, that was terrible. All right, so catalyst number one, summer heat thesis. We are going to have a hot summer. I believe we are going to have a hot summer. And none of this is trading advice. Please read all the disclaimers below. None of this is trading advice. These are words from two energy traders that have traded energy markets for 30 plus years apiece.
So the difference is going to be if we get above 100 and stay there for 2 weeks. It's not if we get to 100 for one day.
right.
It's not if we, it's got to be a sustained demand increase.
Yeah.
And when we say above normal, realize when weathermen say above normal, what they're talking about is it above the normal of the average of temperatures in 30 years beginning in 1990 through 2020. That's
Yep.
their average. It's how they set their average. And so when they say it's higher than average, it's based on that time frame, not last year's.
Not even the last 6 years, really.
Yeah,
So
exactly. Yeah.
Golden Pass, this one's already starting to come online. I probably think it's going to be online fully probably within the next 60 days, I think. Word is. So we'll see if that happens. The EU
Say
panic
word.
word.
Did you say word?
The EU panic bid when policy becomes price, they have a lot of storage to fill. So this is going to be a tricky dynamic. They're going to need to bid up those cargoes because now there's fewer cargoes to bid up. So you're going to see a bidding war between
Right.
JKM and TTF. That's what I think. Now, a producer perspective, don't cap your summer hedges at 271. There is a downside scenario where Henry Hub stays in the 250 to 3. The cost of waiting is maybe 30 cents. The upside case is that there's heat and EU panic and storage draws during the summer. Summer's supposed to be an injection period. If there's summer draws, we could see spikes to 5 to 7. I actually think that's probably a little high, but I definitely see 4. What's recommended structures, and none of this is trading advice. Read all the disclaimers below. Collars and keep the upside set a floor. So
Right. Buying a floor.
a trader and a fund perspective, how to position around a structural dislocation. Go long summer Henry Hub calls. You could just buy calls. Long October Henry Hub versus short the front month. You could use Henry Hub to TTF spread instruments to start trading the spread there.
Yeah, that's a little bit higher risk though.
And then you have Permian midstream on the equity side. You could get into the equities. You could play it that way. So what's the risk matrix? What could keep Henry Hub pinned down indefinitely? A mild summer, Golden Pass is further delayed, Permian associated gas acceleration, and European demand destruction. Demand destruction is going to be something we're going to be talking about probably for the next year, I'd imagine.
So, and let's talk about that definition, demand destruction. What we're talking about there is not a war. Demand destruction is when your gas price goes to 5.50 and you don't take that extra vacation. Demand destruction is when the end users determine that the price is too high, so they're not going to use the commodity, and then they get used to not using the commodity, and then that demand just vaporizes on a long-term basis.
Or I have a real good example. There was somebody I was talking to lives in a rural area. He has a worker that drives out there. It's like 60 miles to get to him to do some work, and he pays him a rate. I don't know what that rate is, but he pays him a rate. Well, when diesel prices jumped up the way that they have, he told him I can't come out anymore. It just costs too much to drive. The
Right.
amount that I'm getting out there out is outweighed by driving 60 miles. I mean, so
So, and here's something you may not have thought of. A lot of people who drive for a business, they get a tax deduction based on a mileage rate the IRS sets. And when that rate is not enough to cover fuel, that stops the business.
yeah. Well, and in that example, I was talking about 60 miles. That's 60 miles one way. He's got to drive 60 miles back,
Right.
because he's got to go home. So demand destruction is it's going to be a topic that we're going to be talking about not only here, but you're going to hear a lot more about it. So where are we in context? Henry Hub is all the way down here at 271. You've got the UK at 1320. You've got TTF at 15. You've got JKM at 1680. These are going to change every single day, every single minute, really. And then you have spot EU LNG delivered at 1450. But this spread, the only way that it would really close if there was excess capacity. And the thing is that there's just not excess. We're shipping out everything that is possible out of the US. So here's the summary, and here's the key takeaways. So the spread is real and structural. This is what Bill was talking about. There's 3 catalysts that can break it, and summer heat, Golden Pass starting up, and the bidding war for EU storage. I actually don't think that's going to be a catalyst to do anything on Henry Hub, but we saw that in 2022 where Henry Hub traded up in sympathy with TTF and JKM, even though it wasn't structural. So just know if that starts to happen, that's not fundamental reality. Traders, the trade is asymmetric. Going long summer calls and October calendar spreads are a low-cost way to bet on heat and low storage. So we're currently about 5% roughly over the 5-year average on storage. It's not really a lot. And when we look at our trusty Rogue Radar, this is telling us for the next 7 days, we've got 1.5 BCF less demand versus the baseline. So watching that number is going to tell you whether you're bullish or bearish. And producers don't give away the option, and keep your positioning fluid to where you can capitalize on spikes. So that's kind of the core. What are your takeaways? What are your thoughts on this, Bill?
I think we're seeing some fundamental changes in the energy business. Um, that's going to have some long-term effects. This is
Mm-hmm.
not a short-term deal. It's not something that's going to be when hostilities cease in the Middle East. That doesn't mean that everything goes back to normal. There's been enough destruction on supply that this is going to have to change how we do things in the future. And I don't think a lot of people are ready for that. And we're keep wishing it's going to go back to how it was. It's just not. And so you need to be looking at your position, whether you're trading, whether you're a physical purchaser or a physical supplier. You need to look at your position and say, how do I make myself as much as bulletproof as possible? And I use that pun specifically, as bulletproof as possible to be able to continue doing the business. And if you need help with that, that's what Brian and I do.
Yep. Yep. And there is a free ebook down below to get you started if you're trying to understand energy markets. And then if you follow, if you're a producer, if you're a consumer, if you're a trader, and we have individual traders, we have hedge funds, we have producers, consumers, different, and we have customers in 5 different continents. So people come because we do assimilate a tremendous amount of insight, because it's not about data. Don't come to us for data, come to us for clarity so that you can understand. For example, all the technical signals tell you the percentage bearish that you are on natural gas or the percentage bullish that you are on crude oil. And then you go down further and you actually are able to see by reference. Like this is something that I found interesting. Our Canadian imports are down 17% versus last year, 27% versus, I'm sorry, 17% versus last week, 27% versus last year, and 14% versus the 3-year average. So that's on the Canadian import side. So that's that means that we got to make up for that gas somewhere else. Now, Permian has a lot of it, but it's really constrained by pipelines. Can't really get there from here. So that's why there's going to be a lot of flaring. But anyhow, we're going to be monitoring Henry Hub, TTF, JKM. If that's important to you, or oil markets are important to you, we follow this and we touch on this every day. Like, subscribe if you're not subscribed, share it with a friend if you want to understand energy markets at a deeper level, because that's what we do day in and day out. So listen, I'm Brian. This guy's Bill. No, wait, this guy.
Yeah,
Not this guy. Not this guy.
So like, who is that guy?
This guy. I always mix up which way I'm pointing.
Yeah.
Wrong way.
Or if you need a rap song for your party, hey, we might be able to pull that off.
Well, listen, folks, thanks so much. Thanks for hanging with us. Drop us some comments or questions down below. We try and get back to all the comments as quickly as possible. So listen, thanks for tuning in. Appreciate you. And we will see you. When will we see him, Bill?
Next week.
We'll see you next week. So thanks so much. We'll see you next week, folks.